Second segment. I'm going to be talking about money management. Everyone say money management.
Money management.
Now, to start off, let me just share with you what I call my 3 laws of successful trading. Right? I wrote this as an article for YTE. YTE is Your Trading Edge, Australia's largest trading magazine. You can pull out the essence of the full article on your new homepage. What is your new homepage? Yes. Isn't that music to my ears? There's a search button on mariosingh.com. Just type in 3 laws of successful trading. Hit enter, the article comes out. Okay? So, the 3 laws are money management, strategies, and state. In particular, I call it state of mind. How I break it down, if this is 100% of your success, how many percent belongs to strategies? Make a wild guess. 30? Good. Some more? How many? 20? Good. Okay, I give the answer. Just gonna play a little bit. 15. 15%. That doesn't mean that strategies are not important. Okay? What it does mean is that if you have the impression that strategies are the only thing, you're setting yourself up for failure. Strategies is important to give you the first kickoff from the running blocks. Because if you think about it, if you don't have strategies, then there really isn't any money management or state of mind to apply yourself to. Clear? Money management is 30%. 100 minus 50 minus 30 is what? 55. So let's go a bit deeper. The way I trade, there's only 4 kinds of strategies till today. Can I show it to you?
Yes.
Number 1, you got to learn to trade the trend. Everyone say trend.
Trend.
You got to learn to trade the range. Everyone say range.
Range.
You got to learn to trade the breakout. Everyone say breakout.
Breakout.
And you got to learn to trade the news. That's it. Everything revolves around these 4 first. You got to understand it. After these 4, let's talk about money management. Now, what exactly is money management, which is twice as important as strategy? If you look at it, right, money management twice as important as strategy, state of mind twice as important as money management. What is money management? How many lots should I play? How much should I risk for a trade? How do I shift my stop loss to break even? How do I bank in profits? How do I exit partially? How do I compound the profits? How do I withdraw and enjoy that money? Money management, 30%. What is state of mind? State of mind consists of 2 things. Number 1, your thoughts. Number 2, your emotions. Let me explain. What is an example of a thought? Well, I'll give you a classic example. Maybe I just draw it here, okay? Now let's just say you're going long. You click buy. Classic, whatever, your entry price, your profit target, your stop loss, okay? Murphy's Law strikes. It hasn't hit your profit target, it's now coming down. And you think, stop. Mario is not looking like. Let me remove the stop loss. I've got to give it space to breathe. So you remove. And after you remove the stop loss, the price actually goes below the stop loss. And a funny thing happens. It actually turns back up and hits your profit target. You know what is the sentence that you will reconcile in your mind? Removing the stop loss is the correct thing to do. Because in this game, many people equate winning with trading correctly. And I shared with you a sentence earlier on. In this game, you can trade wrongly and win. You can also trade correctly and lose. Let's focus on trading correctly. You tell yourself, wow, removing the stop loss is the correct thing to do, especially in times of volatility now, of what we are seeing, which I will cover in detail at the end, the later part of today. You're going to do things like that. Markets will probably at one time, okay, reverse, or even before it turns back up, it wipes out your account. People who don't put stop loss, you can have one of two scenarios. You can make a lot of money. You can make 500% in a month. Some people in fact come to me, Mario, I made 500% a month. I say it's good. I say it's good, but I'm not impressed. I'm not impressed for one reason. Many of us who make 500% in a month, chances are, without even looking at your account, you took on too much risk. Everyone say risk. You might be able to make 500% in a month. All you need to do is to lose 100% one time. You're out of the game forever. It is always that one trade that takes us out, isn't it? But why put yourself in that position? Why put yourself in that position where that trade took me out? So the basis of this segment is going to be called money management. How do we protect our capital? Okay? To give you an idea of what state of mind is, I'm going to be focusing on money management now, in a while. State of mind is whatever we talk about, that thought that you had of removing that stop loss, and you reconcile that it is correct. Let me give you an example of what's meaning of emotions. How many of you heard of this person called Jesse Livermore? Raise your hands. Not many. If ever there was a born trader, this is a true story, okay? If ever there was a born trader in this world, it was this gentleman called Jesse Livermore. He was born about 1890, over a century ago. When this man was 14 years old, he made his first trade. He put his trade in a bucket shop, illegal setting. $5 stock, placed the bet, he made $3.12. Wow, 60% return on his first trade. That set his path to become a world-class stock trader. Do you know, at the height of the First World War in 1913, when Jesse was only about 20 plus, he was worth only $3 million US dollars. To find out how much $3 million US dollars is 1 century ago, just multiply by about 20. That's 60 million in today's terms. Jesse had two rules. Number one, he never listened to anybody. Because how many of you know, if you want an opinion, you will get it. Where do you think the euro is going to go? Oh, it's going to go up. Okay, I click buy. Well, where do you think the euro is going to... Oh, it's going to come down. Okay, I'm going to click sell. He never listened to anybody. Number two, he always added to a winning position. Meaning to say, if it's going in an uptrend, he will always click buy. For some of us, in an uptrend, we will For those of you who started trading, you will notice for a fact that when you hit a major drawdown, it takes you so long to bring that account up just to break even. Not only do you have to make more, you actually have lesser margin to play around. You know that for a fact. And let me show you something of what you're reading out there in the news, okay? Many reporters will only report things, like say it goes up. Today's newspaper got it before you guys know. For the week, the SCI ended 4.9% up. Is that good or bad? If you don't understand the context of it, you might start to think, oh, all in already. What is the context of why it went up? Let me share with you, okay? For some reporters who only report things as it is, listen, when things drop 50%, they might even report to you, wow, from this point it went up 65%, markets went up 65%. And if you just look at the context of 65%, you think it's fantastic. But if you truly understand this formula, hey, you're not even at the point where you fell, you know. Do you understand? Friends? When you lose 90% of your account, what should you do? I tell you what to do. You fund your second life account. At this stage, less than 5% of the world's top traders can bring you back up. You've got almost nothing to play with, man. Almost nothing. So the key statement in this first graph is to tell you why even allow that Pandora's box to open. Have a fixed stop loss, and I'll show you how, okay? Golden question. Why do so many traders blow up their trading account? What is the reason? So I want to address it now. Why do so many of us blow up our trading account? I'm going to show you, okay, 3 levels of traders, of how we calculate our risk. The lowest level are people who don't even calculate. You whack, right? For every trade, you will whack. 5 lots, 8 lots. Oh, today I feel happy. Whack lah, 8 lots. Oh, today markets went up. Whack lah. Oh, today is my son's birthday. 20 lots. No basis. You got no basis. So the first, or rather the lowest level, if I may, are people who don't even calculate at all. The second level, you do calculate your risk, but you calculate it wrongly. And you didn't know. Because you don't know what you don't know. Top level, you calculate it correctly. Now, I won't even deal with the bottom level, okay? Means if you don't even have a plan of calculating your risk, let's deal with the second level of how people calculate wrongly. Allow me to free flow for a while. I'll just draw first, and I'll show it to you on the slide, okay? So let's just say you start an account $3,000. Very simple. You start an account 3K, you open it up with leverage of 100:1. There are certain things that I'm going to mention today, friends, which is why I say you're going to get a master class. I won't be giving you the absolute basics. If you want to find out the top 10 advantages of the Forex market, you can easily go and Google. Largest financial market in the world, $4.3 trillion, leverage of 500:1. That you can find on the internet. Very simple. Let's just say we take leverage of 100:1. Some brokers give you 500:1. FX Primus gives you 500:1 for a start. Now, how people, the first fatal flaw, they will take whatever money they have, 3,000, multiply by 100. They tell themselves, oh, I got 300,000 now because of leverage from the brokers. Divide it by one standard lot, because one lot is 100,000 units. What's the answer here? Let's play along. 3 lots. Wow. Now let's just say you go for a trader with a 1-to-1 risk to reward ratio. This is your entry price, this is your profit target, this is your stop loss. What is your favorite currency pair? Anybody? Euro USD. Okay. By the way, Euro USD is the most traded currency pair worldwide, okay? Because the Eurozone is 15 trillion, their GDP, and USA is 14 trillion GDP. To give you updated knowledge, their national debt in the US used to be only 14 trillion. That's why you always see 100% of GDP. Do you know how many? What is it now? 15 already. 15 trillion. It's more than 100% of GDP, man. The national debt of the USA. I will come to it later. Hey Mario, they owe so much money. Why is the US dollar still so strong? I will come to it later. Let's just say you're playing the euro dollar. And let's just say you take 30 pips. Very simple. And say you're a good trader. You actually put a stop loss. Wow. 30 pip profit target, 30 pip stop loss. Fairly simple. Okay? When these two numbers are the same, this is called a 1:1 risk to reward ratio. Stretch it further. If an example, this is 60 pips. If you win 60 and if you lose 30, this is called a 1:2 risk to reward ratio. Clear? Let's deal 1:1 first. This is just for your understanding. Play along. This trade, you click 3 lots, 30 pips. If you win, how much money do you make? 900, very good. 3 times 30 pips times 1 pip, how much? We learned just now. 10 bucks, right? Is this 900?
Yeah.
How much is 900 divided by your capital? Let's talk about his ROI. What's 900 divided by 3,000? One trade, man. DBS giving us how much in fixed D? When you look at something like that, wow, I'll be a millionaire by next Friday. These are the same group of people who, if you hit a loss, you will lose how much? Do you see how your emotions are tied to the market? Oh, when you hit a great trade, you feel exhilarated. When you hit a loss, your shoulders also go down. Stop trying to be pulled by the market. It's very nice, right, when we win. But somehow we're always blinded to the fact, what if we lose? Shall we just take 2 minutes to look on the other side? Let's look at the dark side for a while. You lose the first trade 30%. Are you still in the game after 4 consecutive losses in a row? Yes or no? Hello? No, huh? Now, listen. Leave here for a while. Let me go to something very interesting, okay? And then I will join the two concepts together. You lose 4 in a row, you're out of the game. Finish. And then you will walk away from the Forex market. This is risky, it's not for me. I was in a panel discussion earlier this year with some of the top economists in Singapore, Singh from CIMB. We were addressing SIAS, Securities Investors Association of Singapore. Someone asked me in the crowd, Mario, is Forex risky? What do you think our answer is going to be? Yes or no? Hopefully after today, hopefully. Not a single one of you walks out this door thinking that Forex is risky. Okay? So it's really more about our belief system. I address that question a bit differently. I say, look, friends, let's stop blaming the Forex market. What is not risky out there in the world? Out there, is it risky that you cross the road, something will happen to you? Of course. You trade the commodities market, you trade wrongly, is it risky? Of course. So why are you so biased against the market that I know? Why are you so biased against the Forex market? Risk is everywhere. Bond safer. We've got 2 examples. You would know friends who were involved in Pinnacle 9 and 10, DBS High Notes 5. Those were bonds backed by sovereign countries. Safer. Class action lawsuit now against Morgan Stanley going on. Bonds really safe. MF Global wouldn't have failed, man. They bet 6.5 billion on European bonds. 3 times more than Goldman Sachs, the largest investment firm in the world. What is safe? What is risk? Risk comes when you do not know what you are doing. So today, please do not blame any financial instrument. And let me give you the ending sentence that I addressed the guy in the crowd in SIAS. Blame yourself for lack of education. Okay? Once you have knowledge, you are absolutely empowered. Clear? Forex is not risky. Yeah? Turn to your partner and say, Forex is not risky. Let's play along. Every trading system or strategy has a winning probability. Now, what does that mean? Give me an example, right? Out of, say, 10 trades, how many trades would you like to win? Correct, that's a correct answer, modern answer. You would like to win 10, correct? Very good. How many of you think what is a realistic number now? 7, wow. 5. Hey, let's be in between lah. 5 and 7 is what? 6 out of 10 lah. Okay? That means if you take 10 trades, you will lose 4, correct? That sounds okay because 5A, 1 to 1, 5 break even or less because of fixed spread. We go 6 lah. Okay? 6 is believable lah. Even if you have a trading system, and for a start, listen to this. Okay? Every trading system has a winning probability, alright? Even with 6 out of 10, watch this. Is it possible for a 60% winning probability that this happens to you? Possible? Could you lose the first 4 and win the next 6? Listen to the punchline now. Oh, sit closer. I'm going to whisper now. With such sloppy money management, are you still in the game after 4 consecutive losses? Yes or no? You're finished. Finished. And then you walk away, crap lah. Forex doesn't work. It's not Forex or crap, it's you or crap. Let me go further. I'm going to bring you down a few levels. You can watch the dream in a dream in a dream. Let's assume that maybe you still survive. You actually had some money left. Maybe your money management is not as sloppy. But after 4 losses, you know what is the thought that's going to be in your head? This trading system is crap. Let me find a free strategy on the internet. You want many? Free Forex strategy, go and type on Google. You got many. Strategy is not the answer. For those of you who walk away at this point, do you know that's the worst thing you can do to yourself? Here's another punchline. Lean closer again. When you lose the first 4, that is the time for you to continue trading because the probability will even out. When you lose early in the game, what does it tell you? The next few will be winning. This is the time you do not give up. Sounds very different, right? This is called probability trading. This is the time you do not walk away from the Forex market. You trade. Of course, all this is dependent that you have a proper trading system at the start, not a crappy one. Stay strong, even if you hit 3 or 4 losses in a row. Are you clear?
Yes.
Oh, you can do better than that, man. Are you clear?
Yes.
So how then do we ensure we do not blow ourselves out of the market? With this understanding in place, how then do we limit our risk? Well, I'm glad you asked. I'll show it to you. Whatever I'm going to show you here is exactly what I free throw here. Okay, so I'll go slightly faster. Again, the question was, why do so many of us blow up our live account? Well, we hear all the messages from the brokers. You can open a standard account anywhere between $2,000 to $3,000. We'll pay you $1 $10. But for some reason, we 3 or 4 losses, we block the whole account. And then we walk away saying Forex is risky. Why? Same example, you start with 3K. Even if you choose leverage of 100 is to 1, let's not talk about if you choose leverage of 200 is to 1. You would think that you can play 6 lots. This is the way how you calculate it wrongly. Wrongly. This is wrong. 3 standard lots, you will make $900, 30%. Fantastic. So much more, right, than what the banks are giving us. You lose 30%. Now, this you write down. And wherever you write it, your next stage, your homework, write it on a new piece of paper. Because you go back home, you're going to burn the paper, stir it inside your 100 plus, and yam sing. Risking too much of your capital per trade. When you do, you will have the exhilaration. Wow! The absolute power that Forex can make me 50%, man, in one trade. What if you lose? What if you lose? Why is no one even considering that? Amateurs are concerned with how much you can make. Professionals are always concerned with how much they will lose. So let's take care of the downside. Now that you know the problem, let me give you the solution. Write down this magical number called 3%. Great traders will never risk more than 3% of their capital per trade. Not more than 3. So it can be anywhere from 1:3. Like 1, 2, or 3. Up to you. Up to you. What does this mean? Example, if you start an account with $3,000, and if you hit a stop loss, you will not lose $900. You will lose only how much? 90. 90. How can you blow up your entire account if you just lose $90, man, per trade? So let's start with that. Money management. Okay? Start with risk. Once you start with risk, you look at the difference here. How many of you have heard of this statement, right? Successful people don't do different things. They do things differently. This is the exact opposite. In this case here, our guy took a swing at the lot size and realized, shit, I blew 30% of my account. Once you start with risk at the very beginning and you tell yourself, I will not blow 3% of my account, you control the risk at the very start. Let's show you the example, right? So let's just say you are willing to risk only 3% for each trade. What does that mean? This is a formula, write it down. Risk equals to lot size multiplied by number of pips multiplied by pip value divided by capital. Write down first, I'll give you an example. Risk equals lot size multiplied by number of pips multiplied by pip value divided by capital. Your job is to calculate the lot size correctly. This is the correct way now. So how many lots can you play if you don't risk more than 3%? A little bit of maths, right? Here is X. Everything else is known. Look up for a while, please. What do I mean by everything else is known? In this formula, risk, you input there as 0.03. 0.03. If you want to risk 2%, you put 0.02. You want to risk 1%, you put 0.01. Capital is whatever is inside your account. How much is it? 3,000, 10 million, 8,564? I don't care. Just put it there. That is the exact amount in your account. Now let's talk about number of pips, okay? This will help some of you. What is the definition of number of pips? Number of pips simply means where exactly is your stop loss. Clear? That means how many pips should you set as a stop loss between your entry price to your stop loss? If it is a long trade, how many pips below the entry price is your stop loss? If it is a short trade, how many pips above the entry price is your stop loss? Let me go further. There's no such thing as a fixed stop loss, in my view. You might be able to put 30 pip stop loss for the dollar yen. You cannot put a 30 pip stop loss for the pound yen. Every currency is different. Every currency pair moves differently. I'll give you an example, okay? What is your favorite food in Singapore? Share lah. No foodies here. Hey, the Casualina Prata was just voted number 1. Have you all tried it? Don't eat one, this crowd. This is our national anthem, makan, right? Chili crab, which one? Jumbo. Melbourne, the one at Ang Mo Kio. Not bad, lah. Not bad. Bella, what's your favorite food? Chicken rice. Fantastic. What else? Fishball noodle. Bak kut teh. Wow. Celebrating with 垂涎30. Nasi biryani. Oh, okay, enough, bro. In just 3 individuals, they got 5 different answers. Bak kut teh, fishball noodle, Melbourne crab, chicken rice. Same in the currency market. How can you expect the dollar yen to be moving the same as the euro Canadian dollar? It's ridiculous. How can you put a 30 pip stop loss for the hourly chart and expect to put 30 pips on the 4 hourly chart? It don't make sense. Your answer is that the number of pips is always measured from the chart. Everyone say from the chart. Let me give you an example. Simple example. So let's just say you are playing uptrend. Wherever you decide to buy. Wherever you decide to buy is dependent on your strategy. So please have one. Some people choose to buy at the turn. Some people choose to buy after the breakout. Whatever it may be. I'm not here to debate which is the best strategy. Because to me, 85% of your success is not dependent on strategy. So where you buy, I'm not particular. When you click buy, that's your entry price. A classic way of putting your stop loss for some people is at the previous low. This is called a low. So when I say it's measured from the chart, regardless of your currency pair, if this is USD versus JPY, this answer could be 33 pips. It could be even USD JPY on the 4-hourly chart. This could be 79 pips. You try putting a 30 pips on the pound Aussie, which over the last 2 years has recorded the largest daily trading range for the last 2 years. Each day it can move on average 237 pips. You try putting 30 pips on the pound Aussie. It's got to be measured from the chart. So if you put the pound Aussie and you look at it, even though it's an uptrend, measure the distance from the chart. Is it 145 pips? If it is, input into the formula. Some of you who start trading may be saying, Mario, if it's 145, I can't take the trade. The stop loss is too big. Once you say that, I know for a fact you're not even calculating your risk. If you look at the formula, can you see if this is a bigger amount, your lot size is smaller? This is in the denominator. When you take a trade of 68 pips, you might be able to trade, say, X number of lots. If you trade with 34 pips, stop loss, you can trade more, right? Because that is in the denominator. So please understand they are a function of each other. Clear? Do you understand that statement? If you have a higher lot size, sorry, if you have a higher pip value, which is measured from the chart, you will have a smaller lot size. If you have a smaller pip value, you got a bigger lot size. That is the summary. Either way, you do not risk more than 3% of your capital per trade. This is the truth. Are you clear? Are you crystal clear? Yes. Friends, this is 30% of your success. Don't mess around with it. 4,003. The next stage, you are making 20% of 4,003. This is the true magic in Forex trading. Don't let anyone else tell you otherwise. What is the definition of compound interest? The money that you make accrues upon itself in the initial equity. Go back to your new homepage, which is called
MySync.com.
Oh, say it like you really mean it. Your new homepage is called
MySync.com.
Go and search the magic of compound interest. I wrote it for Smart Investor, Singapore's top magazine. It will open your eyes. Okay. In fact, let me give you a third article I wrote. It's called Get Leverage. Not covering the essence of leverage today, but I realize leverage is a truly misunderstood term in the retail investing world. Many people will think, hey Mario, the higher the leverage, does it mean I lose more money? No! If you think about it in that formula I just showed you, does it really care whether you got leverage of 50:1 or 500:1? Doesn't matter. It is not dependent on the leverage. Higher leverage only means you put down smaller margin. Read the article, friends. Okay, it's called Get Leverage. It will open the eyes of the retail investing world. You must get high leverage. Okay? High leverage allows you to scale up your wealth. The problem is many retail investors will create an association. High leverage means I will lose more money. Drop that definition in your mind now. It's not the case. Like I said, let's go back to the previous example. Whatever you calculate here, I don't care whether your leverage is 50:1, 200:1 or 500:1, you will get the same answer. The failure, let me just say here, is that when you open with higher leverage, okay, I may confuse some of you, but I'll just say it since I opened it up. You choose two traders, trader A and trader B. He opens here leverage of 100:1. This guy opens leverage of 200:1. The guy who opens with 100:1, okay, if he can play with 6 lots per trade, the guy who opened with 200:1, he has lesser margin for each lot. That means he puts down lesser amount. Does that make sense? Doesn't make sense? Read the article. Doesn't matter. Okay, the article will share with you. I just want to push to the end point. The end point is this. When you open up an account with higher leverage, it is a fact, yes, that you will put down lesser margin. Give you an example. If you open up an account, standard account, whatever the case may be, for every trade that you open up, when you open up leverage of 100:1, your margin that you put down is $1,000. Because 1,000 times 100 equals 100,000. Margin simply means how much you need to put down to represent one lot. That's all. When you open up an account of 200:1 leverage, you only need to put down $500. Because 500 times 200 equals 100,000. So in summary, when you open an account with a higher leverage, you put down lesser amount. The failure of retail traders is that when you have a higher leverage, you think you can open up more lots. And if you don't control your risk, you're finished. That is the part I want you to control. Clear? It doesn't mean if you open up higher leverage, you can play more lots. No. Same. Okay? This is your true magic. After 6 stages of compounding, first stage, the 20% represents what? An absolute amount of $600. At the 6th stage of compounding, 20% represents what? 1,500. This is the magic of Forex trading. Compound interest. Everyone say compound interest.
Compound interest.
It's no different, right? If you think about it in other financial asset classes. How do you guys trade? How do you guys invest? Is it with this knowledge? I hope so. If you think about it, right, your risk is still constant at 3%. You don't change your level of risk. That's all.